bottom of page 13 of the outline, the next subject being personal exemptions. What we're talking about here are deductions which are allowed not on account of any money you spent or any loss you sustained, but rather because you satisfy some other condition of the Internal Revenue Code. Personal exemption is a deduction allowed in the amount of $600, but it doesn't represent an expenditure of $600. It's allowed to you just because you qualify for the personal exemption. We've had questions on personal exemptions twice, September of '62, August of '65. Every exemption entitles a taxpayer to a deduction of $600. How do you become entitled then to a personal exemption? For yourself, you always get a personal exemption. Notice that. Even if you are the dependent of some other taxpayer who claims an exemption on your account, you still, if you are required to file a tax return, claim a $600 exemption for yourself. If you're blind or over 65, you get 2 exemptions for yourself. If you're both blind and over 65, you get 3 just for yourself. For your spouse, same rule. You always get 1 for your spouse. If your spouse is blind or over 65, you get a 2nd. If she's both blind and over 65, you get a 3rd. So husband and wife then can get anywhere from 2 to 6 exemptions just for themselves. Exemptions are allowed for other people as well, but notice this, you can never get more than 1 exemption for any other person. If the person for whom you're getting an exemption is old and blind, if it's not your spouse or yourself, only 1 exemption per person. Number 3 then tells you how you become entitled to exemptions for other people. First of all, in number 3, we're talking about people other than your children. The rules on children are a little more liberal. We'll come to that over on the next page. You get an exemption for people other than your children if, first of all, you support that person, and support means more than 50% during the year, and in addition, the person is either a close relative or lives in your home, and in addition, the person has gross income of not more than $600. Notice the relationship or residence. Either one will suffice. The support must be present, and the gross income must be not more than $600. Example, A supports his widowed mother, who has no income for the year except $1,000 in Social Security benefits. Since Social Security benefits are not gross income, A is entitled to an exemption for his mother. He supports her more than 50%. She's a close relative. She does not have gross income of more than $600, even though she receives more than $600 from Social Security. Notice here in the outline I said a fairly close relative. The law, of course, doesn't word it quite that way. The law gives you a list of relationships which qualify, but it's too long a list to remember. If you want a rule of thumb, think of it this way: a cousin isn't close enough. Ordinarily, it has to be closer than a cousin in order to entitle you to an exemption. As to this resident of your household, remember the exception that the court laid down and which was subsequently codified by the Turnipseed case. Mr. Turnipseed claimed an exemption for a person who lived with him all year. That was his name, Turnipseed, Leon Turnipseed, as I recall. Person lived with him all year, supported the person had gross income of less than $600, not a relative though. He claimed the exemption based on residence. He appeared to satisfy the literal language of the code. The problem was this person who lived with him all year had a husband, and that husband wasn't Mr. Turnipseed, and the court held that since their relationship was in violation of local law, the exemption was nonetheless disallowed. Exemptions for your children. I told you the rules were a little more generous when you're talking about an exemption for your children. Again, you must support the child in order to have an exemption, but then you will get your exemption as long as you satisfy any one of the 3 conditions mentioned here in number 4 in the outline. First of all, gross income not in excess of $600. Well, that's just like anybody else. That's no particular bargain for you. or under 19 years old. So if your child is under 19, even though that child has gross income of more than 600, so long as you support the child, the exemption will be allowed. And finally, if the child is a full-time student for 5 months during the year, the exemption will be allowed even though the child is over 19 and has gross income of more than $600. Example, Mr. A supports his son, 23 years old, who's a full-time student, but during summer vacation earns $1,500. Mr. A gets an exemption for the son because the son is a full-time student. Note, when the son files his own tax return, as he is required to report his $1,500 that he earned, he also gets an exemption for himself. There's new legislation this year providing that divorced or separated parents now may agree at the time of their separation who is to get the exemption, and it's a little more complicated than I'm making it seem, but basically, as long as they agree, the exemption will be allowed to whichever of them their agreement specifies as being allowed to the exemption. The Internal Revenue Service and the courts were wasting a lot of time dealing with cases involving who gets the exemption if people are divorced. It was a matter of spite so many times. Both people would claim it, and the Internal Revenue Service would be in the middle, and they would disallow both exemptions, and everybody would end up in court. Now, to save time and trouble for everyone, as long as the parties can agree, and the time to agree is when they're being separated, the Internal Revenue Service will follow their agreement. Number 5, multiple support agreements, was on the exam in September of '62, and it's a provision to alleviate what would be an unfair result. Suppose instead of one individual supporting another, a group of individuals each provide part of the support of some third party. The usual case is a couple of sons get together to support an aged mother. If no one son provides more than half of the support, nobody would be entitled to the exemption under the general rules, but as number 5 tells you, under the multiple support agreement provision of the code, if the parties who are doing the supporting agree, any one of their number may be allowed to claim the exemption. So look at the example. A, B, and C each contribute 1/3 of their widowed mother's support. By agreement evidenced by signed statements, they all have to agree in writing, any one of them may claim an exemption. Now note, the other requirements must still be satisfied. The mother here obviously is a close relative, and the mother must have gross income of not more than $600 or nobody can claim an exemption for her. The only thing the multiple support agreement does is cause one person to be treated as if he provided the entire support, which really came from a number of people. Continuing then with deductions determined not by any expenditure, but more or less arbitrarily allowed by the code, a corporation receiving dividend income from another corporation gets a special deduction. Congress didn't want successive taxes to be levied on profits which were earned by one corporation and distributed to another corporation. Therefore, when one corporation receives dividend income from another, assuming they are both domestic corporations, United States corporations, the receiving corporation includes the dividend in gross income, but then takes a deduction equal to 85% of the dividend. So suppose Corporation A receives a $100,000 dividend from Corporation Z, $100,000 gross income for Corporation A, but also an $85,000 deduction for Corporation A. There's a limit on that deduction. The deduction cannot ordinarily exceed 85% of Corporation A's taxable income, of course, being computed before this deduction. So suppose Corporation A's taxable income, after all deductions except this one, were, let's say, $90,000. The deduction, instead of being $85,000, that is 85% of the dividends, would be only 85% of $90,000, whatever that happens to be. However, there's an exception to that limitation. If the full $85,000 deduction, the deduction equal to 85% of the dividends, would cause Corporation A to have a loss for the year, then the full $85,000, the full 85% of dividends will be allowed as a deduction, notwithstanding this limitation which I mentioned to you a minute ago. So just summing it up, the deduction basically is 85% of dividends received. However, it will be limited to 85% of taxable income unless the deduction without limitation would cause the corporation to have a loss for the year, in which case the deduction without the limitation will be allowed in full. Percentage depletion, letter E, is a topic of such common conversation and so commonly referred to as one of the loopholes that has to be stamped out that it just might be the kind of thing they'd ask you sometime. Percentage depletion is truly a deduction for something you didn't spend. It's in the law as an incentive for taxpayers who are developing natural resources. And here's the way it works. Any taxpayer deriving income from a mineral deposit, whether it's oil or sand or rock or what have you, includes the proceeds of selling that mineral in gross income, but then is allowed a deduction equal to a percentage of that gross income, the percentage varying depending upon the type of mineral involved. For instance, in the case of oil and gas, the highest percentage applies, that being 27.5%. So if a taxpayer has $100,000 of gross income during the year from his oil well, he's entitled to a deduction on his tax return of $27,500. He didn't spend $27,500. He didn't spend anything in particular having to do with this deduction, but this arbitrary deduction is allowed. The deduction might be a lower rate if it were a different type of mineral, and the code, of course, specifies you shouldn't be expected to know those rates. There is a limit on this depletion deduction. Your depletion deduction may not exceed 50% of your net income from the property before depletion. So in that $100,000 gross income example, if the taxpayer had other expenses, salaries and what have you, development expenses related to that oil well of, say, $60,000, so that the net income from the property before depletion had been only $40,000, the depletion would be limited to $20,000 instead of being allowed in the full potential amount of $27,500. Now, page 15, we come to some bad news. All of what we've been talking about so far were provisions allowing deductions, whether because of the reason for the expenditure or the nature of the expenditure or for no reason at all. Now we come to what I like to call the left hand taking away what the right hand gave you, the right hand being all these provisions allowing you deductions. Now we find sprinkled throughout the Internal Revenue Code provisions which say, notwithstanding anything else herein to the contrary, a deduction will nevertheless not be allowed if, and then they give you some situation in which a deduction will not be allowed. So here in the deduction situation, in order to be sure you have a deduction, you have a two-step process not entirely unlike what we had in the gross income situation. In order to be positive you have a deduction, you must first find some section of the law allowing you a deduction, and you must then be confident that there is no section of the law taking away your deduction. These taking away, disallowing provisions supersede all the provisions of the law which allowed the deduction in the first place. And there's really no easy way to correlate them and talk about the disallowing provision at the same time we talk about the allowing provision to give you just a net answer, because these disallowing provisions cut across many different allowing provisions, so that the only real way to handle it is, I think, is as we're doing here today, discussing each type of provision separately. Well, let's begin with them then. First of all, lobbying expenses. Suppose you have a deduction which, under some provision we've already discussed, would be allowable as a deduction, but suppose it happens to represent a lobbying type of expense. Let's suppose you decide it would be good for your business if a certain bill were passed by the state legislature. So you spend a lot of money lobbying to get that bill passed. That seems like an ordinary and necessary business expense, so that it would qualify under the deduction provision we spoke of last time. But does the fact that it constitutes lobbying cause it to be disallowed as a deduction? Well, here we have to look carefully at the provision of the statutes as it now exists. The law used to be that all lobbying expenses were disallowed. The law now is that an expense will not be disallowed merely because it constitutes lobbying unless it falls into one of two categories set forth here under 8A on page 15. The types which will be disallowed are amounts expended in connection with the political campaign of a candidate for office. So if you decided that having Smith elected was a good thing for your business and you got on his bandwagon and spent a lot of money, that would be disallowed as a deduction. And further disallowed, amounts expended to influence the general public with respect to legislative matters, elections, or referendums. That would also be disallowed as a deduction. So suppose you take billboards and say vote no on whatever it is, that would be disallowed as a deduction because you are attempting to influence the general public. But this first example I gave, where you appear before the state legislature to try to convince legislators to vote the way that would be good for your business, will not be disallowed, and assuming it qualifies as some kind of a deductible expense, the deduction then will be allowed. Be sure you understand that. If I went down to Springfield to try to convince them to do something which I just think is a good idea, let's say to vote prohibition in the state, well, there's no provision under which I could claim that as a deduction. So even though it isn't the type of item which would be disallowed as a prohibited lobbying expense, I don't get a deduction because I can't find any allowing provision entitling me to that. On the other hand, if I went to Springfield to argue that sales tax should not be levied on professional fees, that would have something to do with my business. The disallowing provision would similarly not operate, and I would have a deduction if it's that kind of a situation. So all we're talking about here, remember, is whether or not something otherwise allowable will be disallowed by one of the provisions we're now addressing ourselves to. You must always first point to an allowing provision. Congress got themselves really twisted up on political advertising a couple of years ago. It appeared, allegedly, that some political parties in this country were putting a great deal of pressure on people to take ads in ad books of different types of political gatherings. And this was thought to be a way of indirectly helping candidates for office, which of course is always disallowed as a lobbying expense. So Congress a couple of years ago passed a provision of the code saying ads in ad books sponsored by political parties, which will flow through to the benefit of political parties, are disallowed as deductions. So General Motors, let's say, takes an ad in an ad book saying buy a new Chevrolet. That's disallowed as a deduction, even though that same ad in the Chicago Tribune would be allowed as a deduction, simply because the profit of it flows through to a political organization, which the Chicago Tribune is not. However, then they woke up this year and realized they had two conventions to run, and they said to themselves, my God, what did we do? Because the ad book has traditionally been a principal source of revenue for the convention. So this year, just a month or so ago, as part of this tax increase bill that went through, they put in an exception for this advertising and said that, however, ads in an ad book of a national political campaign with certain limitations on it, so that it obviously meant just the Democratic and Republican conventions this year, will nonetheless be allowed as a deduction. So this year, the ads in the convention books will be deductible, even though a couple of years ago Congress decided that that type of thing no longer should be. This year they had to get down to business and run a convention, and after all, first things come first. There was a series of disallowing provisions that came into law in 1962 as a result of what Congress felt was some abuse, some liberties that taxpayers had been taking with the rules of deducting entertainment and similar expenses. The courts had been quite liberal in interpreting what type of entertainment and traveling and so forth constituted an ordinary business expense. The case that seemed to break Congress's back was the Sanitary Farms Dairy case, in which the management of a dairy company, happened to be husband and wife, went on a safari to Africa, big game hunting. The dairy company paid the cost of the trip, and the tax court allowed it as a deduction. The court said if that type of thing is an ordinary necessary travel and entertainment expense, then we've got to change the law. Their basis for allowing the deduction was they took movies while they were there and brought back stuffed animals and heads and so forth, displayed them in their dairy company offices, and attracted a lot of people to the office to see the movies and see the displays, and presumably sold more milk as a result. But Congress thought that was a little far afield and thought the law needed to be sharpened up somewhat, and therefore in 1962, as I tell you here in B1, they put in a very severe disallowing provision affecting entertainment, amusement, and recreation, which a safari to Africa would be, which taking a client out to a dinner or a party or a show or a football game would certainly be. Any of these things, even though they would be deductible were it not for these provisions I'm telling you about, may now be disallowed unless they satisfy one of the conditions set forth here under B1. First of all, if they are directly related to business. Now let's take an example. You take a client out to a show, let's say. That would be an ordinary and necessary business expense so that you have your deductible provision. But now, are you okay? Are you qualified under this non-deductible provision, under this disallowing provision here? In order to be directly related to business so that the deduction will not be disallowed, the regulations say just about that you have to be talking business during the show. You have to be trying to solicit business or solicit an order right during the entertainment in order for it to be directly related. It seems to me that entertainment under that test, if that is the rule, and the courts haven't yet really discussed it because it's quite recent, if that's the rule, we can't count on any entertainment being directly related, because if you're selling, it isn't really entertainment in the first place, it's just a sales call. They do have one relief provision in the regulation, which I think reflects a great deal of understanding on their part. They say that if you intended to conduct business during the entertainment, but you were prevented from doing so because of causes beyond your control, it's nonetheless directly related. And of course, the thing that brings to my mind is where you did too good a job of entertaining him in the first place, and he's just not in a condition to discuss business by the time you're done with him. The second exception, which I think has a great deal more significance to us, allows the deduction, or putting it more precisely, does not disallow the deduction if the entertainment precedes or follows a business discussion. So suppose your client's in your office talking business, and then after you close the deal, you say, now let's go out and have some fun. That kind of entertainment will not be disallowed since it precedes or follows a substantial and bona fide business discussion. If the business discussion is just a put-up thing, just to allegedly qualify the entertainment, of course it will not be recognized. Letter C, if the entertainment takes place in circumstances conducive to a business discussion, even though there is in fact no business discussion, that entertainment will not be disallowed. We usually refer to this as the quiet meal rule. Congress put this in because they didn't want to prevent you from taking your customers and clients for quiet entertainment. It's just the noisy entertainment that they wanted to prohibit. So if you take your customer to a dinner at a quiet restaurant, that will not be disallowed, assuming it otherwise qualifies as an ordinary and necessary expense. If you take them to some place where the noise is so loud you can't hear yourself think and the people are jumping around, making a lot of commotion, presumably that's not conducive to a business discussion, depending on your business, I suppose, but for most types of businesses, that would not be conducive. And letter D, there are some other exceptions in the law. There are some other ways in which you can qualify, but really these other exceptions, there are 8 of them, are not really exceptions as I view them. What they really are talking about are such obvious things that I don't think we even need to mention them to know about them. They're very minor importance, so I'm skipping them in the outline. They're just no importance at all. Number 2, gifts. Congress got tired of facing a situation where one party deducted an item as a business expense and the other party said, I don't have to report that as gross income because it was a gift. They felt there was a slippage in the tax revenue this way, and they said, okay, from now on, a gift isn't deductible, except to the extent of $25 per donee per year. So you have a good customer, and you send him a TV set for Christmas, and you say, well, I can deduct that because he's a good customer, and he says, I don't have to report that because it's a gift. Somebody's going to lose on that one. If it is in fact a gift so that it isn't includable in his gross income, the sender of it loses his deduction, except to $25 per donee per year. Actually, I think if you'll recall the Duberstein case, that kind of thing wouldn't be a gift. That kind of thing would probably really be gross income to the recipient. But Internal Revenue Service recognizes some of the laws of business, and if they come along examining the tax return of a businessman and they say, what about that color TV set, he really can't say that it was not a gift and send the Internal Revenue Service to call on his customer to collect the tax. As a realistic matter of business practice, he has no choice but to say, yes, I guess that was a gift after all, and suffer the disallowance of his deduction, even though the really right answer would be that he's entitled to the deduction and the customer ought to pay tax. He just can't afford to alienate a customer that way. If he's a good enough customer to send something in the first place, he's a good enough customer not to give a referral to the examining agent for this particular man. That's not going to help your business. Transportation expenses, number 3, what that all boils down to is much ado about nothing. They amended the law twice in that area. They put out some regulations, and when we're all done, here's what it comes down to. If you take a trip, and it's primarily a business trip, even though you decide to extend your trip and have a vacation while you're there, the entire cost of traveling back and forth will be allowed as a deduction. Internal Revenue Service has been very upset about that. They've thought for a long time that if you mix business and pleasure, even though it's primarily a business trip, a part of your transportation expenses should be disallowed. Congress made a weak stab at doing that, but then they amended the law so that they took away even that, and finally the regulations, which the Internal Revenue Service itself published, pretty much killed the whole idea. Here's the example. Suppose you go from here to New York on a business trip, and the fare is $100, let's suppose, and you decide to spend an extra week on a vacation while you're there. The cost of the extra week, meals and lodging, is of course not deductible because that's got nothing to do with business. But what about the $100 car fare that you spend? Should that entire amount be deductible if part of your time is spent on a vacation? The answer is, as long as business was the principal purpose of the trip in the first place, the entire deduction will be allowed. There is a limited exception. I'm just fighting a little cold. I hope I make it. There's a limited disallowance if the trip is outside the United States, in which case a proportionate part of your transportation costs might be disallowed, but even then will be disallowed only if obtaining a vacation was a principal purpose motivating you to take the trip, and realistically, if it was primarily a business trip, I don't see how the vacation aspect could have been a principal purpose in the first place. There is that limited exception which I've mentioned to you. It just isn't very important. The rule to remember is if it was primarily undertaken for business purpose, the whole transportation is deductible. The living expenses day by day are either deductible or non-deductible, of course, depending upon whether this was one of the vacation days or one of the business days. Lavish and extravagant traveling expenses are not deductible. What does that mean? Nobody knows. There's no case. There's no really good example in the regulation as to what constitutes lavish or extravagant. The way I like to think about it is if you live much better when you're traveling on deductible money than you do when you're traveling on your own money, you probably ought to be concerned about this, unless there's an awfully good business reason why you need to put up a front. Suppose when you're on vacation you stay at the YMCA or you camp out. And when you travel on business, you take the luxury suite in the finest hotel in town. That might be lavish or extravagant, and it might not. If you're entertaining customers and you want them to think that you're really a first-class successful company, perhaps that suite serves an important business purpose. So just bear in mind that there may be a problem there, and you'll be able to handle any question, and you can pretty much pick your own answer. Finally, none of the above are deductible unless substantiated by adequate records. The court once had a case involving the playwright George M. Cohan. He was a bad record keeper, and he said, I know I spent a lot of money, but I don't know how much. I'm spending money every day of the week traveling, entertaining people. The court said, well, we realize you must have spent something. We'll allow a reasonable estimate bearing harshly on you, allowing only a small figure because of the fact you didn't keep records, but allowing something nonetheless. This came to be known as the Cohan rule, in which a court, if you didn't have any records, for many years would allow at least something for your trouble. That is no longer the rule today unless you have good records, written substantiation, supporting any of this type of thing: entertainment, amusement, recreation, gifts, transportation, traveling expenses. Without good records, your deduction will be lost. Even though everybody knows you must have spent something, they won't allow 10 cents unless you have good records. It's not a matter of whether they believe you or not anymore. The law now says you must have the records. The records really are now one of the essential elements of the deduction. The example I like to think of is Abraham Lincoln on the witness stand in tax court, and the court saying to him, it isn't that we don't believe you spent the money, Abe, but if you don't have the records, we know you always tell the truth, honest Abe and all that, but if you don't have the records, we just can't allow the deduction. The records are essential whether we believe you or not. Public policy is another cause for disallowing a deduction that would otherwise be permitted. Deduction which would otherwise be allowed is disallowed if it would frustrate public policy to allow it as a deduction. We've had a couple of important developments here. First of all, fines for violation of state statute are non-deductible. A speeding ticket, you can't deduct that even if you were speeding to see a customer or some such thing. Illegal payments, a bribe to a public official, even though that might help a person's business. Suppose his business is bootlegging liquor or narcotics. A bribe to a public official, even though that might be essential to stay in business, would be disallowed as a deduction because the very payment itself is illegal, and to allow a deduction for a payment which is illegal would frustrate a public policy. Insiders' profits, the Internal Revenue Service used to say that if an insider had a profit which he repaid to the corporation of which he was an insider, he was not allowed to deduct that repayment. Now, some of you don't know what an insider is. An insider is a director, an officer, or a large shareholder of a publicly held corporation. If that person makes a profit by trading in the stock of that corporation over a short period of time, generally less than 6 months, he's not allowed to keep that profit. He must pay that profit over to the corporation. The theory is perhaps some inside knowledge helped him make that profit, and he shouldn't be allowed to benefit by his inside knowledge. Even if he can prove he didn't have the knowledge, though, he must repay that profit. It's an absolute, in effect, a presumption against him. Well, suppose he makes a profit and has to pay it over to the corporation. He has to pay tax on the profit. He has to report the profit as gross income. Can he deduct the repayment? Internal Revenue Service used to say no, because this would frustrate a public policy. The public policy is to punish insiders. The courts didn't agree with that and said this isn't punitive. This is just a matter of fairness among the shareholders. It's just a matter of economics. And the Internal Revenue Service finally changed their rule so that today, admittedly, when an insider repays a profit to a corporation, he can deduct his payment for tax purposes. Very important case 2 years ago, which is number 4 in the outline, the Tellier case, T-E-L-L-I-E-R, Supreme Court, 1966. I have been guessing that if there were one case I'd be putting on the bar exam, this would be it, above all others. I think it fits in so nicely with so many of the other landmark decisions you've been studying. It's unnatural, but they haven't asked it yet. I'm sure they will someday. It's just a matter of time. The courts used to say, let's take it this way. Suppose you're accused of a crime. It costs you a great deal of money to defend yourself. If the crime arose out of your trade or business so that the costs of defense can be considered an ordinary and necessary business expense, should they be deductible? Or should they be disallowed on the grounds that public policy shouldn't do anything to help a person who's accused of a crime? Well, obviously, if you're accused and acquitted, public policy shouldn't operate against you, because if you're innocent, you should have the full benefit of every possible tax deduction. What if you're convicted? Suppose you're accused and convicted of a crime arising out of your trade or business. Should the cost of that unsuccessful defense be allowed, or should it be disallowed on public policy grounds? The Supreme Court said many years ago that the cost of an unsuccessful criminal defense should always be disallowed on grounds of public policy. The court in 1966 in the Tellier case reversed itself and said even if you are convicted, public policy does not disallow your deduction. Public policy is not against the concept of a guilty person being properly represented. On the contrary, as all the recent decisions of the Supreme Court show, public policy requires that even a guilty person be well represented. So, remember that Tellier case. The actual facts were the man was in a securities business. He was convicted of some sort of a stock fraud plan and paid a fine or went to jail. But nonetheless, he spent a lot of money on his defense. The Supreme Court allowed him to deduct that defense money even though he was a guilty party. Price fixing, revenue ruling in 1964, was published specifically because of the damages which the electrical equipment manufacturers had paid about that time when they were convicted of fixing prices. Just about all the large manufacturers of electrical equipment in the country paid substantial fines because they had, or at least were found guilty, of fixing prices among themselves in violation of federal law. The damages which they paid were allowed as deductions by this revenue ruling. The government didn't even contest it. They allowed the damages. Their reasoning was that these damages for price fixing are not punitive in nature, so that there is no public policy against allowing them as a deduction, but rather are compensatory in nature. The damages, note, run to the injured party, to the customer who presumably overpaid, rather than punitive. One exception was made in that ruling where the claimant is the federal government. In that situation, they were disallowed, the ruling holding that in that situation the damages were intended to be punitive. So damages for price fixing are not disallowed on grounds of public policy. unless the claimant is the federal government. That's the rule. That I mentioned because it got a lot of publicity at the time. Many congressmen felt that the Internal Revenue Service had been much too liberal, and they appointed a congressional committee and they studied the subject and they held a lot of hearings, but nothing ever came of it except an awful lot of shouting. It was one of the last rulings published before Commissioner of Internal Revenue Kaplan left, and after he left, a lot of congressmen had a lot of bad things to say about him on account of this ruling, but they didn't decide to legislate, so they must have decided that he wasn't so crazy after all as they had at first suggested. Letter D, losses on sales between closely related parties are not deductible. Suppose I have some stock which I bought for $10,000. It's worth $8,000 today. I'd like to take that loss on my tax return, but I don't want to get rid of the stock because I think it's going to go back up. So I arranged to sell it to my wife. She happens to have $8,000. She buys it from me. Now if it goes up, we've got the profit in the family, and in the meanwhile, I've got my $2,000 loss. But I cannot deduct that loss because any loss on a sale between a husband and wife or between an individual and a controlled corporation is not deductible. That same provision of law disallowing that deduction has a second part to it. I didn't put the second part on the outline because I didn't think it was fair game for a question. 5 years ago, the examiners disagreed with me. I think they get my outline once in a while. And put it on the exam. Let me tell you what this question was, and you tell me whether you agree with me or not. There's a provision in the law here which says that a taxpayer on the accrual basis, let's say a corporation, the usual case, that was the fact here, a corporation on the accrual basis cannot deduct unpaid expenses due to a controlling shareholder unless the amounts are paid by the corporation to the controlling shareholder within 2.5 months after the corporation's year end. Take this situation. The corporation owes its 100% shareholder some salary at the end of its year, let's say December 31st. The corporation's on the accrual basis so that it deducts expenses when they become liable for them. Unless the corporation pays that salary within 2.5 months after December 31st, the corporation cannot deduct that salary now or any other time for that matter. I think it's kind of a fine point to be asking on the exam, but they did ask it 5 years ago, to my surprise. Letter E, another disallowing provision. Premiums on life insurance covering an officer, an employee, or any other person financially interested in taxpayer's business are disallowed if taxpayer is directly or indirectly a beneficiary under the policy. This takes into account the typical key man insurance arrangement. Suppose a corporation has a very valuable president. They realize were he to die, the corporation would be injured. So they carry $1 million of insurance on him. Very smart thing to do in a lot of cases, and surely that's an ordinary and necessary business expense. But it's disallowed as a deduction if the taxpayer, the corporation, is directly or indirectly a beneficiary, as it surely would be in the example I mentioned. On the other hand, remember, if he should die and they collect the proceeds are excludable from their gross income, so there is some sort of equity. It does sort of balance out if you want to look at it that way. And yet I find it puzzling how they've picked on the insurance provisions so many times here. I guess it's because insurance salesmen are such good salesmen that these things become popular, and then Congress says they're popular, we have to stop them. Expenses of producing tax-exempt income are generally not deductible, letter F. So, for instance, suppose I go out and borrow some money to buy some municipal bonds. The municipal bonds yield exempt income. The interest expense I pay on the borrowed money, even though it's interest, will be disallowed as a deduction because it's an expense of producing tax-exempt income. The courts have held that there's a distinction between exempt income and deferred income. F1 tells you about the Hawaiian Trust Company case. Remember when we talked about gross income, exclusions, and then the second list, which was deferrals? The Hawaiian Trust Company said there's a difference between a outright exclusion and a deferral, and this disallowing provision applies only to expenses of producing exempt income, not to the expenses of producing deferred income. So keep that fine distinction in mind if you can. If it's merely a transaction on which the income is deferred, your deduction will not be disallowed. We've had a number of cases recently in this area of expenses of tax-exempt income. The government got a little too ambitious in this municipal bond interest situation. They tried to say that just about any time you had interest expense and municipal bond interest in the same year, that interest expense should be disallowed. The code says that it'll be allowed if it's incurred in order to acquire or retain obligations producing exempt income, and the courts, the Internal Revenue Service said any time you incur interest because you borrow money and at the same time you own municipal bonds, you could have avoided the borrowing by selling the municipal bonds, so that the borrowing was always incurred to carry the municipal bonds, so that any time you have interest expense and municipal bond interest income at the same time, that interest expense is disallowed. No tracing of funds or matching of dollars required. They tried a case last year, the Wisconsin Cheeseman case, and I'm sure you all get their mailing Christmas times the way I do. Wisconsin Cheeseman is a company in Wisconsin that sells cheese, if you didn't know, and mail order. And it's a highly seasonal business. They sell these nice gift packages, you know, $2 worth of cheese for $11.50 with a ribbon around it, that kind of thing. And they find that during large parts of the year they have a lot of excess capital, and during their peak period they need a lot of money. So what they do is they go out and take out temporary loans and so forth. And the court said that the government went much too far in claiming that just because they had interest expense and interest income at the same time, the interest expense should be disallowed. For one thing, they allowed a deduction for the interest on their mortgage on their building, saying that they shouldn't have been required to sell the municipal bonds in order to pay off the mortgage. It's a perfectly natural thing to have a mortgage. And the case, I think, stands for the proposition that unless you can find some connection between owning the bonds and the borrowing, the interest on the borrowing will not be disallowed. Just the mere presence of a borrowing and interest income at the same time will not suffice. You'll have to trace funds or something in order to have the disallowance. Allocation between years, allocation of income and deductions between years. Assuming you know what's gross income, what's a deduction, a further problem, which could well be the subject of an exam question or part of an exam question, is what year does it affect you? Is it this year, next year, or none of the above? Taxation is, of course, always based on the income and deductions of a taxpayer for a taxable year. It's an annual concept. You take stock once a year, figure out what your taxable income is, apply the rates. The income tax rates are annual rates, and that's the way your tax is paid. You settle up once a year. What is your year? Your year isn't necessarily a calendar year. Your year is whatever period you want it to be. When a new taxpayer files its first return, it can select a calendar year, June 30th year, any other taxable year it wishes. Suppose you formed a corporation today, July 1968. You could elect a July year-end, a September year-end, any month end you wanted could be your year-end just for the asking, and the same is true of an individual. 99% or more of all individuals use calendar years, but it doesn't have to be that way. You can, when you file your first return, choose a fiscal year. Once you file a return and choose a year, however, you need permission to change, and permission will ordinarily be granted only if you can show some non-tax reason why granting the permission is a good idea. Assume then that you've chosen a year. Suppose you're using a June 30th year for this particular taxpayer. which deductions fall in the year ending June 30th, 68, and which deductions fall in next year, and same for income. How do you tell? How do you allocate items of income and deduction between the different years? There's no one way to do this. There are several ways of doing this. The two most common ways of doing this are the cash method and the accrual method, ACCRUAL. Taxpayer can allocate income and deductions between taxable years under either of these methods. However, he must use one method consistently. He must pick a method at the beginning and then stick with it. Under the cash method, there are certain principles of how you make this allocation, which we're just about to discuss. Under the accrual method, there are different ways of doing it. So let's look at them. The March 66 bar exam asked a question involving the cash method. Under the cash method, income is includable in the year it's actually or constructively received in cash or property. Actually or constructively received in cash or property. So if your taxpayer is using the cash method, he'll report gross income when it's received in cash or property, actually or constructively. What does constructive receipt mean? Constructive receipt means he could have received it had he wanted to, but by his own action he prevented himself from receiving it. The most common example is the bank credits interest to your passbook on your savings account in December. You don't go to the bank for 5 years, you don't collect that cash. They don't even put it in your passbook, but on their records, it's yours. You have constructively received that at the time they credit it to you on your records. The regulations say that constructive receipt means the amount has been credited to you or set apart so that you may draw upon it at any time. And certainly that interest has been so credited to you, even though by your own action, by staying away from the bank, you don't reduce it to actual possession. Suppose, and I think young lawyers-to-be like to think about the time when this would happen. Suppose on December 31st, a client walks into your office with his pen and his checkbook and says, now that bill you sent me, I'm ready to settle it up now, I want to pay you. And you say, stop. I've already got enough income this year. I don't want your check yet. Come back next week and I'll accept it. Isn't that a pleasant thought to imagine getting to that position? Well, if you do get to that position, let me recommend that you not chase him out after all, because when he gets out his pen and his checkbook, you have constructively received that already, so it's gross income to you even if you throw him out without taking the check. You might as well take the check because it's constructive receipt anyway. Notice that under the cash method, it can be received in cash or property. There doesn't have to be any money at all involved. Suppose you work for someone and they pay you 10 shares of stock, or a basket of eggs, or a new automobile, or any other kind of property. You have income when you receive that property. What about a note? Suppose you do work for someone and they give you a note. Have you received anything? Do you report income on the cash method when you receive that note? The answer is yes. If it's transferable and has a value, the note is income and has to be reported by a cash basis taxpayer to the extent of its value at that time. Example, A sells property to B, who gives A his negotiable note for $1,000, which is worth $950. A is treated just as if he received $950 cash. If you had merely entered into a contract and didn't get a transferable note, you wouldn't have to report it until you got the money. If you get a non-transferable note, you do not report anything even though the note has a value at the time. But a transferable note is reported by a cash basis taxpayer to the extent of its value. And of course, letter C, as I told you already, a mere promise to pay is not property. You have no gross income on the cash method if all you have is someone's promise, written or oral, but not a note. A transferable note, you do have income. Expenses on the cash method are deductible when paid. Notice I didn't say actually or constructively paid. It must be actually paid in order to have a deduction. So that client of yours that you threw out of your office didn't have a deduction even though you had income because he didn't actually pay you during the year. There's no such thing as constructive payment. There is only such a thing as constructive receipt. Payment may be in property, however. If you, let's say, transfer some stock to someone in payment of an expense, you have a deduction at the time you transfer the stock. Payment needn't be in cash to have a deduction, even on the cash method. So the word cash method is kind of a misnomer. We could call it receipt and payment method and be a little more descriptive of what it's all about. Perhaps the use of the word cash is a little misleading to you, because look at all the times you can have income and deductions without any cash, without any money as such, really changing its hands. The accrual method has nothing to do with when payment is made or received. If a taxpayer is using the accrual method, income is realized, income is reportable, when all the events have occurred which fix the right to receive it and the amount can be determined with reasonable accuracy. Example, A sells goods to B under an agreement whereby A is to be paid next year, no right to payment this year. A nonetheless has income this year because this year all the events occurred fixing his right to the income. The amount could be determinable. Similarly, you perform some services and agree on a price this year, even though payment isn't received or isn't due until next year. You have gross income this year on the accrual method. Expenses are deductible in almost exactly the same way under the accrual method. Expenses are deductible when all the events have occurred which fix the fact of liability, and the amount can be determined with reasonable accuracy. So take any of those examples on gross income under the accrual method, and the person with the expense would have a deduction at the same time. There are a couple of exceptions to that. If an obligation is contested, it does not become deductible until the contest is settled or the amount is paid, whichever comes first. Now, suppose I'm on the accrual basis, and today a liability comes into existence, and the amount can be determined with reasonable accuracy, and all the facts have occurred which cause the liability to come into existence, but the only problem is I don't admit it. I say, nothing doing. I don't agree. I don't owe the money. And we fight about it for 5 years, and it finally turns out I was dead wrong. I didn't know what I was talking about, and I owed the money after all. Well, even though that really came into existence in 1968, I can't deduct that until a later time because I contested it. A contested liability, even under the accrual basis, becomes deductible only when it's paid or when the argument is settled, whichever comes first. There was a Supreme Court case a few years ago, the Consolidated Edison Company case, dealing with this subject. The law has been changed since the Consolidated Edison Company case. The rule I just gave you is the present law. If you should run across that Supreme Court decision, bear in mind that it reflects old law. The law was changed because Congress didn't like the result in the Consolidated Edison Company case. They changed the law so that the result was the opposite. In other words, they changed the result by legislation, prospectively, as I recall. Well, no, I guess it could have been retroactive even on an elective basis. Letter B here, what is the meaning of all the events have occurred which fix the fact of liability? A lot of taxpayers have been in court saying, today when I sell something, I can predict that on the average it's going to cost me something because I made that sale. Therefore, I should be able to deduct today what it's going to cost me because I made the sale. Let me give you the most common example. Suppose I'm an appliance dealer and I sell you a refrigerator today for $200. And I know that on the average, it's going to cost me $20 to service that refrigerator during the warranty period. So by selling that refrigerator, I have on the average sustained $20 of expenses. I sell thousands of refrigerators, and I know some are going to cost me nothing, some are going to cost me much more, but the average is going to be $20. Can I today deduct that $20, which is going to cost me per refrigerator, at the time I sell a refrigerator? The courts say no. Even when past experience shows some liability will arise in the future, It may not be deducted at present unless the amount can be determined now, the amount of fixing that specific refrigerator in that example. When the customer calls and says this lemon quit working, then you have your deduction, because then the liability to fix that particular one came into being. Before we continue here, let me just point out one thing. This whole subject of when you report income and when you claim deductions, what I've been calling allocation of income and deductions among taxable years, is sometimes referred to as the subject of tax accounting. I try to stay away from that phrase, at least until we get this far, because I find here again, this is another term that frightens people. If I say, now we're going to talk about tax accounting, oh, no, we don't know anything about that. We're not accountants. How can we ever answer a question about tax accounting? But if I tell you that all we're talking about is allocating income and deductions among taxable years, that sounds pretty simple, and I hope it holds your attention a little better. But just to refresh your recollection, those of you who do think in other terms, this subject is often called tax accounting. That's all tax accounting means, is determining which year you report something. Number 5 here deals with what we usually call prepaid income. That's the prepaid income isn't really the right title for this type of thing, but that's what it's commonly referred to as. Income received now for something to be done in the future, for property or services to be given in the future. Is that income now or isn't it? Suppose a client of yours comes in and pays you in advance for some work you're going to do next year. Is that income now or is it income next year? It's income now. The law is very well settled. Anything received is income when you receive it, even though you have to earn it in the future. The landmark cases on here, the first one is in the example, the American Automobile Association. You come in on December 31st, let's say, and pay a year's dues, entitling you to road service for next year. That's income under the general principles, which we're talking about, and that's what the Supreme Court held at the time AAA receives your $25. Schluty case, another Supreme Court decision. Schluty was a dancing teacher and a terrific salesman. I really admire Schluty, because he would have people, his customers, sign up for 10-year dancing lesson contracts, lifetime dancing lesson contracts in some cases. What a salesman he must have been. And he got people to pay in advance for this in a good many cases. He ended up in the Supreme Court arguing that he shouldn't be required to report as gross income these advance payments, because he hadn't yet earned it, and he had the obligation to provide dancing partners for all these people all these future years, and that really he wasn't making that much profit after all, because look at the expense he was going to go to. The court said no, nothing doing, gross income when received, even though you're going to earn it in the future by providing the dancing lessons. We had the Hagen case, tax court decision in 1966, which was the first case involving advance payments for the production of goods as distinguished from services. The Hagen case, the taxpayer was to produce some property and they received money in advance. They were required to report this advance money as gross income at the time received. The Angelus case, tax court decision, 1967, was one I was kind of surprised about. I had always thought that in some of these cases, when you read the language, part of the court's reasoning was you couldn't tell whether in fact the taxpayer was or was not going to be called upon to carry out the required agreement. For instance, in the Schluty case, the people might never have turned up to dance. He might have had a windfall. How could you be sure? But the Angelus case is one where that was not part of the possible fact result, because Angelus was a funeral director, and this involved advance payments for funerals, and whether or not Schluty's customers showed up, you could be positive that Angelus's customers were going to show up, because it was not within their control, obviously. Nonetheless, the tax court held that Angelus had gross income at the time the payments were received in advance for these prospective funerals. Incidentally, it's surprising, in case you're not familiar with it, the tremendous percentage of people who arrange for these things in advance, buy their graves in advance, pay for their funerals in advance, very, very much in the minds of the public. They don't want to have their families burdened with it, or maybe they're afraid they won't get the same fine send-off unless they arrange for it in advance, but it's very, very common for these things to be paid for in advance. Another case, the Art Nell case, a 1967 decision. Art Nell, as some of you probably recognize, is the Chicago White Sox company. The name of the company that owns the White Sox is Art Nell. The question here was whether when the White Sox sold tickets in advance for next year's season, their year happened to end at a certain time and they were selling some tickets, whether they have to report that as gross income. And you might have thought that the law was so well settled by this point that they wouldn't even go to the tax court. Nonetheless, they did go to the tax court. They lost their case. The court said, we've decided this many times before. You're no different from Schluty or Hagen or Angelus or the American Automobile Association. And they lost their case, so that advance payments for baseball tickets are gross income when received. I think maybe they did it just for the good publicity of boasting that they sold that many tickets in advance. I suppose if the Cubs had that situation, they'd probably go to the Supreme Court just to let everybody know about it. Although I heard yesterday that they sold a lot of tickets. Amazing. The American Automobile Association, when they lost their case in the Supreme Court, as I told you about in that example, went to Congress, and Congress changed the law for them. 5B here tells you about amendment to the law in 1961, which applies really to the American Automobile Association and just about nobody else, providing that if a membership organization, that means an organization which does not have stock outstanding, receives dues income, that's kind of income that American Automobile Association was concerned about, they can report that dues income ratably over the period covered by the dues. So the law today is, if you come in on December 31st and pay your $25 for a year's membership in AAA, they can report that $2 a month over the next year instead of reporting it all the day they receive it from you. The Supreme Court held otherwise. The law has since been changed, but the change in law applies only to this very limited class of taxpayers. The Supreme Court decision, of course, applies to taxpayers at large. The only other exception to that is a publisher of a periodical may report subscription income ratably over the period covered by the subscriptions. So Life magazine, suppose you send in $10 for a 3-year subscription, they can report that $10 part in each of the 3 years covered by the subscription, rather than all at once when they receive it, as other types of taxpayers have to report their prepaid income. The last point before we take a break, prepaid payments. What about the person paying something in advance? What about somebody incurring or paying an amount now for services or property to be received in the future? Advance payments are ordinarily not deductible until the time when the services or the property are received. For instance, suppose you pay 5 years' rent in advance. The court will not allow you to deduct that advance rent. Their theory is to allow you to deduct the 1969 rent in 1968 would distort your income. Well, what about the person receiving it? He's got to report 1969 rent in 1968. The landlord has to report it all when he gets it. For some reason, that doesn't trouble the court at all, distorting his income, because that's good for the federal revenue, and that justifies distorting income. But on the payer's side, advance payments are not deductible until the period to which they relate. Okay, shall we take our 15-minute break at this point? All right. We'll continue with the installment method at the bottom of page 17. They asked on the March 62 bar a very comprehensive question involving the installment method of reporting income. Regardless of whether a taxpayer uses the cash or accrual method as an overall method, if property is sold and the payments are to be received in installments, the seller is allowed to report the profit ratably instead of all at once. Is allowed to report the profit as installments are collected. Here's the way that would work. Suppose I sell you my piece of real estate, just as an example, it could be any kind of property, and you're to pay me 10% each year for the next 10 years. I will then report 10% of my profit each time I collect a payment from you. In order to choose the installment method, there are a couple of prerequisites which were mentioned on the exam specifically. First of all, the payments in the year of sale must not exceed 30% of the selling price unless the taxpayer is a dealer in personal property. So in that situation I mentioned to you here, I'm selling my piece of real estate. If I get more than 30% in the year of sale, I can't use the installment method. If instead I'm a dealer in personal property, suppose the transaction is the sale of a washing machine on credit, I can use the installment method to report that even though I get 40, 50, 95% in the year of sale. 30% limitation on the payments in the year of sale unless you're talking about a dealer in personal property. One further limitation, which isn't mentioned here, you can't elect the installment method on personal property unless the selling price is $1,000 or more. Again, that doesn't apply to a dealer in personal property either. So if I sell you, let's say, some stock for $500, I can't elect the installment method. I can elect the installment method on personal property only if it's more than $1,000. Number 8, suppose I have a bad year. Suppose I've been paying tax right along on my taxable income. This year, something goes wrong and my deductions exceed my income. If the government is my partner in the good years, shouldn't the government be my partner in the bad years? Well, for about 40 years they have been, by means of what is called the net operating loss provision of the code. This provision says that if I have a negative taxable income, that negative taxable income is allowed as a deduction in certain other taxable years. Specifically, I carry that excess back and claim it as a deduction 3 years ago. Suppose I'm talking about a negative taxable income, a net operating loss, in the year 1968. I take that as a deduction in the third preceding year, that's 1965. Obviously, I didn't claim this as a deduction when I filed my 1965 tax return. How could I have known in 1965 what was going to happen in 1968? That would have looked a little suspicious had I claimed on my 65 tax return my loss, which I am going to realize in 68. What I do is, when I have the loss, I go back and file an amended return or a claim for refund, asking a refund of the tax now due on account of 1965 because of the 68 net operating loss, which I just realized became a deduction in 65. If I didn't have enough income in 65 to use it all up, I carry the unused part to the second preceding year, 66 in my example. If I've still got some left, I carry it to 67, and if I've still got some left, then I carry it forward to the next 5 years in order of time until I either use it all up against income in those years or the 5-year period elapses. So a net operating loss can go back 3 years, forward 5 years. It must go in that particular order. You can't choose any other order, and if you can't use it during that entire period, it expires, and that's the end of it. One point I really should make here is I have said that the negative taxable income is the amount of your net operating loss, and I took a little liberty when I said that. Actually, there are certain adjustments which must be made to your negative taxable income to arrive at your net operating loss. The only thing I really want you to know is not every time you have a negative taxable income will you have a net operating loss because of these adjustments. Again, here, I think for our purposes right at this time, we've done enough if we just mention the subject, know that much about it, without getting into the details of what the adjustments are. I think we have to make a value judgment as to how much you can absorb, recognizing that you have one or two other subjects on the exam as well. Number 9, the top of page 18. Gain from the sale of inventory. Of course, when you sell property, your gain or loss is the difference between your selling price and its cost. That's simple, no problem about that. But what did it cost? Suppose you sell something. What did it cost you? If you visualize a very small situation, it's easy to know what property cost you. If you bought an automobile for $2,000 and now sell it for $1,900 or $2,500, you know what that automobile cost you. It's very easy to keep track of it. But what if you're in a situation where you deal in great volume of like products? What if you are Sears Roebuck and Company, and you have Lord knows how many thousands of different items, and you're buying these items every day at fluctuating prices? You walk into the neighborhood Sears Roebuck store and you buy 50 cents worth of nails. Now, do you suppose that Sears Roebuck has a man who can figure out what that little package of nails cost them so that they can figure out whether they made 25 cents, lost a dime, or made some other amount on that sale of nails? There wouldn't be enough people to do the figuring if they had to keep track on an actual basis of what these nails actually cost them. Obviously, the cost of nails, I assume, fluctuates from time to time, so that they'd have to earmark what day they were bought and how much these particular things cost. Nobody can do it this way. Nobody can specifically identify the cost of what they sell unless it's a very, very small type of a situation. Even the corner grocery store would have a difficult time doing that. So what people do instead, what taxpayers do is, they keep a written record of all their purchases, and then they shortcut the arithmetic a little bit, but this is the way it works out. When you buy a bag of nails, they simply look at their list of nail purchases, and they either work from the top of the list or work from the bottom of the list in figuring out what that particular bag of nails cost Sears Roebuck or wherever else it might be. Suppose they find that at that moment they have a list of nail purchases covering the last 5 years, some of which cost 12 cents a pound, some of which cost 30 cents a pound. If they work from the top of the list and say that these nails cost them 12 cents a pound, they'd report a 38-cent profit on your 50-cent purchase. If they work from the bottom of the list and say that the nails cost them 30 cents, they'd report a 20-cent profit on your 50-cent nail purchase. They can do it either way they want. In figuring out the cost of property which is sold, taxpayer can either make either one of two assumptions. Taxpayer can assume that the oldest items purchased are the first ones sold, or taxpayer can instead assume that the newest ones purchased are the first ones sold. Working from the top of the list would be assuming the oldest ones were the first ones out. Working from the bottom of the list would mean that the newest ones are the first ones out. These assumptions, a taxpayer can make either assumption at once, but it must use the same assumption consistently. Letter A here, the first assumption they might make, the assumption that the oldest ones on hand are always sold first, is usually referred to as first in, first out. That makes sense, doesn't it? Or shorthand, FIFO. Anytime anybody says FIFO, that's all that means. The oldest ones on hand are assumed to be the first ones sold on a continuing basis. The other assumption, working from the bottom of the list, assuming that the newest ones acquired are sold first, is referred to as last in, first out, or LIFO. Now, you'll often hear people talk about using LIFO inventory, and they make it sound terribly complicated. This is all it means. This is all LIFO inventory means. Picture Sears Roebuck working from the bottom of their list of nail purchases to figure out how much profit they made. That's LIFO, assuming that the most recent ones purchased are sold first. Notice you can use either assumption you wish. They needn't have any relationship to the facts. Perhaps you have the best warehouse people imaginable, and they always make sure that the oldest stuff is shipped out first. Nevertheless, you're allowed to use LIFO if you wish, even though it can be proven that the fact of the matter is just the opposite. I give an example with refrigerators. I've already given you an example involving nails. Doesn't make any difference what the item is. The principle is common to them all. Number 10 is an exception to the provision as to when you deduct expenses on the accrual method. If the expense involved is compensation for services, you can't deduct it until you pay it. You recall that under the accrual method, expenses are deductible when all the events have occurred fixing the fact of the liability, and the amount can be determined with reasonable accuracy. Here's an exception. If the item you're deducting is compensation to employees, it cannot be deducted until it's paid. This is usually referred to as deferred compensation. Deferred compensation is deductible only when paid. Here's an example. A hires B at $20,000 a year, also agrees that when B retires, he'll continue to get $20,000 in each of the 5 years following retirement. All the events have occurred fixing that. The amount is reasonably determinable. Nonetheless, even though A is on the accrual basis, he cannot deduct those post-retirement amounts until retirement comes and they are actually paid year by year, $20,000 in each year. The purpose of this provision, of course, is to prevent the employer from deducting today something on which the employee won't be taxed until some later date. There's only one way in which you can accomplish that purpose, that is, having a deduction today and gross income to the employee later. The only way to accomplish that is to adopt what is known as a qualified plan. And why don't you put those words in quotes? Qualified plan of deferred compensation. If you have a qualified plan of deferred compensation, the employer can claim a deduction today for compensation which the employee does not report as gross income until some later date. Qualified plan of deferred compensation requires that the amounts be paid today either into a trust or over to an insurance company. In either case, the money then is paid either from the trust or from the insurance company sometime in the future. The employer deducts the amounts when paid over to the trust or insurance company today. The employee reports the amounts when received from the trust or insurance company, usually following retirement or whatever the plan provides. Qualified plans of deferred compensation can take a lot of different varieties. They usually are either profit-sharing plans under which some percentage of profits is set aside each year in this manner for employees, or pension plans under which some predetermined amount is set aside for employees to provide a guaranteed pension to them upon their retirement. Qualified plan, as I told you, really belongs in quotes because it's a very specific phrase. It has a specific definition under the Internal Revenue Code. Qualified plan, in order to be qualified and allow you this deduction today, must meet a couple of requirements. First of all, it must be impossible for any payments made to it to revert to the employer. There can't be a string on it. There must be no conditions on it. All the money paid over to that trust or insurance company must ultimately someday somehow be used for the benefit of employees. Secondly, it must be non-discriminatory. That is, It must apply to a large group of employees. You can't just have a qualified plan, let's say, for officers or for the president. It must apply to large classes of employees, and it must not unduly benefit officers, shareholder employees, supervisory, or highly paid employees. So suppose you set up a plan and you included all your employees, but everybody is going to get a $10 pension, except the president. He's going to get a $10,000 pension. That would be discriminatory, and it would not be a qualified plan. On the other hand, you don't have to give everyone the same dollar amount of pension. Suppose the president earns 10 times what the janitor earns. The president's pension can be 10 times the janitor's pension. However, it can't be 50 or 100 times the janitor's pension. The discrepancies in the relative amounts must be in relation to what they're earning during their years of activity. Number 11 was on the exam in September of '56, options granted by employers to employees. Ordinarily, if an employer gives an employee a right to buy something at a favorable price, the employee has income to the extent of the benefit so received, either when he gets the right or when he exercises it. And the rules on when it is which time get a little too complicated to go into for your purposes. But ordinarily, suppose X company happens to own a piece of real estate. They give the employee a right to buy it at a certain price, and later on he exercises that right and he has a good profit because he then turns it over at a higher price. He'll have compensation income there probably at the time he exercises that option. The only way for an employer to give an employee a right to buy something at what turns out to be a favorable price and yet not have the employee recognize any income either at the time of grant of the option or at the time of exercise is to have the option be what is known as a qualified stock option, which I've underlined here, and you can put it in quotes if you wish. It's a very specifically defined term. A qualified stock option means an option to buy stock of the employer corporation. So the employer obviously has to be a corporation to have stock. For instance, you're working for the A corporation. A corporation gives you an option to buy A corporation stock. If they give you an option to buy Standard Oil Company stock, forget about it. That can't be a qualified stock option. It's got to be the stock in the employer corporation in order for it to be qualified. And further, the option price must be at least 100% of the value of the stock as of the time the option is granted. Now you may say to me, well, what is so great about that? That's like ice in winter, giving an employee an option to buy something for what it's worth. What's so wonderful about that? The answer is that's quite a nice thing to have because it puts the employee in a very favorable situation. If the value of the stock goes up, he can exercise his option and make a profit. If the value of the stock goes down, he just forgets about it and doesn't exercise. So he's in the position of an investor who can't lose. Most investors aren't in that position. Most investors who buy stock are going to win or lose depending on whether the stock goes up or down. As a matter of fact, if you want to buy an option, you can yourself tomorrow buy an option on whatever stock you might want. There are companies that deal in this type of thing. Suppose you want to buy an option to acquire stock of the A company at today's price anytime within the next year. You can buy that option, but you'll pay a price for it, even though the option price, the exercise price, is today's value. So that proves that the employee is getting something which some stranger would be willing to pay for. Let's assume that the employee gets an option which is a qualified stock option because it's the employer's stock and the option price is today's value. The employee has no income when he gets that option, no income when he exercises the option. The only time he has income is when he finally sells that stock, if he ever sells it, some later year. And there's a simple example here. He gets an option, he exercises it, he sells the stock at a big profit someday. He reports that profit someday when he finally sells it, and incidentally, reports it as capital gain at that time, even though it arose out of an employment relationship. Gains and losses from sales of property, we've had a lot of questions in this area last few years. I'll point them out to you as we go along. First of all, how much gain or loss do you have when you sell property? Well, as I mentioned in passing a few minutes ago, the amount of gain or loss from selling or exchanging property is the difference between the amount received for it and your adjusted basis for the property. And this kind of a general question was covered in March of 66 and August of 66. So if you sell something for a certain amount, your gain or loss is the difference between what you get for it and your adjusted basis. So we have to examine both of these things. What is meant by the amount received? The amount received is very simple. You won't have any difficulty figuring out how much you received. It's either the cash you get or the value of the property which you get for it. Suppose you trade. I trade my General Motors for your Ford stock. I have gotten for my General Motors stock an amount equal to the value of that Ford stock. That's the amount received. That's easy enough to tell. If it's something that's difficult to value because it's not regularly traded, some appraiser or ultimately some court will always know its value. So all you have to do is know that it's the fair market value, which is the important figure. Adjusted basis is a little more complicated to figure out. Not that there's anything mysterious about it, it's just sort of a complex idea. I have been using up until now the words cost or tax cost basis because I've wanted to be general with you until we got to the point where I told you what I'm really referring to. All those times, of course, I've really been meaning adjusted basis, and from now on I'll try to remember to use the words adjusted basis because that's the real name of the real term for the measuring stick which is used in calculating gain or loss. Adjusted basis is in turn a two-step concept. First you have to know basis, then you have to adjust it. What's basis? Basis depends on how you got the property. If you bought it, your basis is your cost. That's very simple, and I suppose that's why people so often speak of cost basis, because I guess most property is acquired by purchase, so that most of the time cost and basis are synonymous, and we get in the habit of saying cost basis, which isn't really a proper legal term. If you inherit property, your basis is the fair market value at date of death, and that was on the exam in August of 66. One exception to that is if the executor, for estate tax purposes, chooses to value the property at the optional valuation date, which is 1 year after the date of death, then your basis for the property so inherited is also the value at the optional valuation date. Incidentally, there's been a lot of activity in Congress directed toward changing this rule, and for that reason, perhaps it's something you ought to keep in mind as a fairly timely subject. There haven't been any changes, there haven't been any litigation of particular importance, but it's been in the news. In March of 58, they asked this question under B1 prime here. If you receive property from a decedent before his death, but the property is nonetheless includable in his estate, your basis is also the fair market value at date of death. So property acquired by inheritance really embraces more than simply property inherited in the usual sense of the word. Any property received from a decedent before his death or at his death and includable in his gross estate, your basis is fair market value at date of death or a year later, as I mentioned. That would include surviving joint tenants. It could be by will, it could be by intestacy, it could be any receipt before death, such as a gift in contemplation of death, which leaves the property in the gross estate. Property acquired by gift, the basis is the donor's basis, plus any gift tax paid by reason of the gift. So if your father gives you some stock worth $10,000, which cost him $1,000, your basis is $1,000 plus his gift tax, if any, on the transaction. A lot of people come up to me and say, gee, that's not the way I remember it. I remember that it's the fair market value at date of gift which becomes the basis. And I say, well, no, I'm sorry, that's not the law. And they say, well, maybe the law has been changed since I went to school. And I have to admit that the law has been changed there. The law used to be otherwise in the case of gift. The law was changed December 31st, 1920. So if your recollection is to the contrary, maybe you ought to go into another line of work if you've been here all those years. You were here before we were. Property, remember, anytime you have an exchange on which gain or loss is not recognized, we have some special rules which we talked about last time about carryover basis and reducing basis by non-recognized gain and so forth. Remember, you've got to keep that in mind and go back and refresh your recollection about those special basis provisions we had on the non-recognized gain transactions. Anything I say here now does not supersede what I said the other day about basis in the event of non-recognized gain. Just take one simple example. Transfer property to a corporation sold in exchange for its stock or securities, and I thereafter control the corporation. My basis for that stock will be whatever my basis for the property prior to the exchange was. Adjustments. If you know basis, you have to adjust it. Depreciation is the most significant of all adjustments. Every dollar of depreciation you claim on property is a dollar reduction in the adjusted basis. It adjusts the basis downward by a dollar. If you improve property, the cost of the improvement is an upward adjustment in the adjusted basis of the property. So let's take an example here. A's aunt dies January 1st, leaves him a building worth $50,000. A claims $5,000 in depreciation, sells it the following year for $60,000. His gain is 15. How'd I get that? His basis started out at 50 because it was inherited. The 5,000 in depreciation reduced his basis to 45,000. When he sold it at 60, the difference between the amount received and the adjusted basis was 15,000. Note, letter C here, this was on the exam in September of 59. If you transfer property in satisfaction of a liability, you're treated exactly as if you had sold the property for an amount equal to the liability and compute your gain or loss accordingly. Suppose I owe you $10,000. I bring you some stock worth $10,000, which you accept in full payment. I treat that exactly as if I sold it for $10,000 and compute the gain or loss on the stock. What we've talked about here about computing the amount of gain or loss is of universal application. Regardless what kind of property you're dealing with, this is how you compute the amount of the gain or loss. Once you know the amount, however, you have to ask yourself the further question, is it just possible that this gain or loss might be a capital gain or a capital loss? It's important to know that, because if it is a capital gain or loss, the effect on your tax computation, the effect on just what you do with it, will be different than if it isn't a capital gain or loss. So anytime you have a gain or loss from property, ask yourself, can this be a capital gain or loss? Why is that important? Let's flip to page 21, letter F at the top, and then we'll come back. There are three reasons why it's important to know whether a gain or loss is a capital gain or loss. First of all, the limitation on deductibility of capital losses, which we talked about earlier. Capital losses, recall, are deductible only to the extent of capital gains, plus in the case of a non-corporate taxpayer, an extra $1,000. Secondly, the 50% deduction allowed to a non-corporate taxpayer having long-term capital gains requires, of course, that you know the amount of the capital gains and losses. And finally, the alternative tax computation, which we haven't mentioned, a provision saying that no taxpayer pays more than 25% on his or its net long-term capital gain for the year. Regardless what the regular way of computing tax turned out to be, you can always just take your capital gains, your long-term capital gains and losses out of the tax computation, pay a flat 25% on those long-term capital gains, and just compute the tax on the rest of your income in the regular way. So that's why it's important to know. Now, how do you tell? What's a capital gain or loss? A capital gain or loss is a gain or loss from the sale or exchange of a capital asset. Fine. What's a sale or exchange? What's a capital asset? Those are the two things you have to identify. Let's take capital asset first. The code doesn't tell us in so many words what is a capital asset. Instead, it tells us what isn't a capital asset. The code says every property is a capital asset except, and then it gives us 5 exceptions. The reason the code approaches it from this direction is if they were to try to list all the capital assets, it would be a never-ending job, because there are thousands and thousands of types of things that can be capital assets. There are only 5 types of things that aren't capital assets, so it was obviously much simpler for the drafters of the legislation to put it in these terms. Here are the 5 things that aren't capital assets. Everything else is. You know, if you took a survey on LaSalle Street today when you got out of class and said, what's a capital asset? 9 people out of 10 would tell you stocks, I'm sure. But in a minute, think of all the things that are capital assets aside from stocks. Here are the things that aren't capital assets. First of all, inventories aren't capital assets. Inventory means property which you sell to your customers in your business, your stock in trade, your goods on the shelf, property held for sale to customers in the ordinary course of trade or business. That's what's meant by inventory. Next, property used in a trade or business. Your building, your equipment, your machinery, your trucks, all the things which you use in your trade or business, your desk in your law office. These are not capital assets either. Compositions in the hands of their creator. Literary, musical, or artistic compositions. I suppose I paint a painting. That's not a capital asset as to me because I am its creator. If you own a painting which you bought, that may be a capital asset because you're not its creator. Receivables from sales of inventory and/or services are not capital assets. A client owes you a $5,000 fee. That amount due from him, that claim against him, is not a capital asset, so that if you sell that at a profit, your gain is not a capital gain. Finally, short-term government obligations issued at a discount basis and not bearing interest, example, treasury bills, are not capital assets. And that's it. There isn't anything else that isn't a capital asset. Everything else in the world is a capital asset. Your securities which you own, unless you're a dealer so that they are inventories, will be capital assets. Piece of land which you bought, your home, your car, your furniture, your clothing, just about everything you own in the world, only these 5 things excepted, is a capital asset. In order to have a capital gain, though, you have to have a sale or exchange. What is a sale or exchange? Usually a sale or exchange isn't difficult to recognize. You know a sale when you see one. Money for property. An exchange means they swapped property for property. About the only time we have any difficulty here is, suppose the asset involved is someone's debt. Suppose this debt happens to be a capital asset. For instance, suppose you give a note to someone who lends you some money, and you give him a $10,000 note and he lends you $9,000 cash. And suppose that note is a capital asset, as to him which it probably would be. When you pay that note, his $1,000 gain is not capital gain because your payment is not a sale or exchange. Debtor's payment of his obligation is not a sale or exchange. If he sold that note to a third party, that would be a sale or exchange, so that he would have capital gain in that situation. And that's the example given here in the outline. The courts have done a little embroidering themselves on these rules, and I believe that there are some situations where, even though under the exact language of the statute, the answer should be one way, the courts have said, no, we don't think Congress really meant it that way, and they've grafted on exceptions of their own. Under letter C, I tell you about 2 of these situations. Suppose a taxpayer has an annuity or an endowment policy which is fairly close to maturity. If taxpayer collects the proceeds from the insurance company which issued it, the amount received is going to be ordinary income, the amount in excess of taxpayer's cost, because that will not be a sale or exchange. But suppose taxpayer instead takes that policy and sells it to some third party. It seems to me that that is a sale or exchange, and if it is a capital asset, it ought to yield capital gain, but the courts say no. The courts say if you sell an annuity or an endowment policy to a third party, all you're really doing is converting what would be ordinary income if you didn't sell it, attempting to convert ordinary income into capital gain. Therefore, it should be treated the same as if you didn't sell it. I find that a little hard to follow, why they should ignore the sale, why they should say, since you would have ordinary income if you hadn't sold it, you should also have ordinary income even though you do sell it. Well, if you sell it and you sold a capital asset, you ought to have capital gain, but the courts have for some reason balked at the idea of capital gain from selling an endowment policy or an annuity policy. I don't really buy their reasoning, but there it is in case it should appear on the exam. The other provision where I think the courts have done a little legislating involves a loss on property acquired for business purposes. Suppose the usual example here would be I buy stock in a corporation because by being a stockholder, I am better able to receive an assured supply of material which I need in my business. If I later sell that stock at a loss, what about that loss? Well, the stock looks like a capital asset, the sale looks like a sale, and yet the courts will allow an ordinary deduction if you can show that the reason you bought the stock was to get a source of supply of some material, some item which you need in your business. As I said up above, gains and losses from property used in the trade or business are not capital gains or losses, because property used in the trade or business isn't a capital asset. However, there's a special provision in the law, and this was hit on September of '61 bar exam, whereby if you sell property used in the trade or business at a gain, and the gains from such sales during a year exceed the losses from such sales during the same year, that net gain, the excess of gains above losses, is treated as a capital gain. This provision was put on during World War II to encourage taxpayers to sell their excess productive plant facilities, which, if it weren't for this provision, would have yielded ordinary income, and with excess profits rates, the government would have taken the whole profit. This was put on in World War II to make it economically feasible for taxpayers to sell their property used in the trade or business, which they weren't using at the moment. However, World War II has been over for 23 years, and this provision remains with us, and today still, if the net gain from property used in the trade or business is a net gain, that gain is treated just like a capital gain, even though really by definition those assets weren't capital assets. For instance, you have two machines, you sell one at a gain, one at a loss, the net gain is treated as a capital gain. You make that netting computation on an annual basis. Each year you make the computation. Since 1962, however, there's been a little extra provision grafted onto this. To the extent that the gain results from depreciation claimed on the property, that amount of the gain is ordinary income, and only the rest of the gain above the depreciation recapture portion, which is what it's referred to as, enters into this netting computation. Look at the example. A company sells two machines during the year. Each was held for more than 6 months, and $200 in depreciation was claimed on each after '61. Only the depreciation claimed after 1961 subjects you to this ordinary income recapture treatment. It sells one at a $500 profit, the other at a $100 loss. Result, machine sold at a gain. $200 is ordinary income, because $200 of depreciation was claimed on that machine after '61, so $200 of its profit is automatically ordinary income. The rest of the profit, $300, is treated as a gain from business property, which is then netted against the loss from the other machine, leaving a net gain of $200 from sales of business property during the year, and that net gain of $200 will be reported as a capital gain. Notice one further thing. This depreciation recapture provision, treating the gain equal to depreciation claimed after 1961, does not apply to gains from depreciable buildings. There's a different recapture provision which applies to gains from buildings, but I'm not going to tell you about it because it's of such limited application and of such moderate effect on the taxpayer that it just is not a tenth as important as this one, which applies to personal property. But I would want to point out to you that this one does not, this recapture provision I've given you in the example here, does not apply to buildings. Letter E. We keep using the words long-term and short-term, and that means just one very simple thing. A long-term capital gain is a capital gain from something held more than 6 months. Short-term means it wasn't held more than 6 months, capital gain or loss. If it's more than 6 months, it's long-term. If it's less than 6 months, it's short-term. That example there got a little mixed up. The dates got a little mixed up. It was such a simple example anyway. All it was intended to show is if you buy something on January 1st and sell it in June, it's short-term gain or loss. If you sell it in July, it's long-term gain or loss because it's held more than 6 months. Again, letter F we've covered already. So let's go on to the next question. Who is the taxpayer? To whom is income taxable? Income is generally taxable to the person who earns it or to the owner of the property which earns it. If I go out and work and earn a salary, that salary is taxable to me, even though I tell my employer and we agree at the time of employment that all salaries are to be paid to my son. I earn it, it's includable in my gross income. Similarly, if I own a piece of property and I tell the tenant to pay the rent to my daughter, that rent is my gross income since I own the property which earned it. That was on the exam in March of '62, an assignment of the income from property, the income remaining taxable to the owner of the property. We had a case a few years ago, Teschner, T-E-S-C-H-N-E-R. Teschner came across an essay contest which anybody was eligible to enter, and anybody could write the essay, but the terms of the contest were the prize would be payable only to somebody under the age of 17, I believe it was. The idea being this was going to finance a college education for some person. Well, Teschner wrote the essay, sent it in, and named his daughter as the person who was to be the recipient. His essay won. Daughter received the prize, and the question was, whose income is that, his or his daughter's? Internal Revenue Service said, you wrote the essay, it's your earnings, it's your gross income. The court said, no. The court said it's the daughter's gross income, since by the very terms of the contest, there was no way in which you could have received it, so that it wasn't an assignment of income. It was something available only to her right from the beginning. Teschner won his case. Interestingly, he happens to be a practicing tax lawyer, did a good job on his own case. It's a risky thing for a tax lawyer to try his own case, because if he loses, the publicity is people talk about him. Number 3 there, cross out, that was sort of a peculiarity 5 years ago when I first put it in, that version of the outline. It's old enough now that it just isn't worth mentioning anymore. Number 4 was on the exam in September of '58. You can't merely assign income. You can't take your income and have your income paid to somebody else. If you give away your property, the income from the property thereafter is the gross income of the owner. What if you go halfway in between and give away your property temporarily? The way someone might do this is put his property in a trust, the trust to continue for a period of years, and after that period of years, the corpus to come back to the original settlor and the income to be for somebody else's benefit. What about that situation? to whom is the income of that trust taxable during the trust's continuance. The statute is very clear on that now. The income is taxed to the trust as long as the reversion is not going to take effect until at least 10 years from the date of creation, or you could provide until at least 10 years, that the reversion is to take effect at the death of the beneficiary, or you could provide that the reversion is to take effect at the death of the settlor if his life expectancy is at least 10 years when the trust is created. So suppose I put $100,000 worth of bonds in a trust for my son, the trust to continue for 11 years, and the income to belong to my son. At the end of the 11 years, the bonds are to come back to me. That income is taxed to the trust. If instead I had said it comes back to me at the end of 9 years, that income right from the beginning is my gross income. Putting in the trust didn't change one thing as far as the tax effect. If instead I said the trust is to terminate and the bonds are to come back to me at my death, that income would also be taxed to the trust, since my life expectancy based on mortality tables as of today is more than 10 years. If I said until the death of the beneficiary, even if the beneficiary is a 99-year-old man, it's not taxed to me because the code specifically says the lifetime of the beneficiary is a long enough period of time. Credits against tax. I told you that a credit reduces tax. It's much better than a deduction because a deduction reduces taxable income, a credit reduces tax dollar for dollar. Retirement income credit is available to anybody over 65 who is retired, and I'll tell you what retired means in a minute. Any person over 65 gets a credit equal to 15% of his retirement income, but the credit may never exceed $228.10. That's what the law says. The retirement income means pensions, annuities, interest, dividends, and rent. In other words, income that you don't earn, the type of income, passive income, that a retired person would have. If you're not retired, that is, if you earn more than $2,974 during a year, you will lose the credit. If you earn less, you lose part of the credit. But if you're over 72, you get the full credit, regardless how hard you work and how much you earn. Social Security benefits prevents you from claiming the credit. This credit is intended for people who don't get Social Security, and if you receive Social Security in excess of $1,524, you lose your credit. A lesser amount of Social Security costs you part of your credit. Foreign taxes paid to foreign countries on income included in your gross income are allowed as a credit against your U.S. tax. Take the simplest example. A lives in Chicago, receives $100 in dividends from a Canadian corporation on which he pays a Canadian tax of $15. The $100 dividend is, of course, included in his gross income. The $15 is allowed as a credit against his tax, reducing his U.S. tax by $15. Special tax rates. Husband and wife may file a joint return if they wish, but they're not required to. Usually, a joint return will result in a tax saving. The effect of a joint return is as if the total income were divided in half, their combined total income, and the combined total deductions were divided in half, and the tax were figured then on half of the taxable income, and they paid in total twice the tax on half of the income. The only reason a joint return is beneficial is because our tax rates are so steeply graduated. Suppose husband and wife have taxable income of $30,000. On a joint return, the tax will be twice the tax on $15,000. If most of that taxable income belonged to, let's say, the husband, the tax on the joint return will then be less than the tax were they to file separate returns. If their taxable incomes are about the same and he and she each have about the same amount of income, you may find that a joint return produces no benefit or may in fact cost you something. A head of a household has another special way of computing tax. A head of a household gets to use a special lower schedule of tax rates. Actually, they start at the same percent, they reach the same percent, but they aren't as sharply graduated as the tax rates applicable to other taxpayers. A head of a household gets to do this just by qualifying as a head of a household. To be a head of a household, he must be unmarried. Peculiarly, a married person can't be a head of a household for this purpose. And he must do one of the following three things. He must maintain a home which he shares with a child or descendant. Notice, he needn't be supporting that child. I had one situation where I had a 70-year-old woman who lived with her mother, and the mother paid the costs of maintaining that home. Mother was 94. The daughter was entirely self-sufficient. As a matter of fact, she was retired and collecting Social Security, and she'd never married. And the mother was entitled to file as a head of a household because the daughter, who was financially independent, actually quite well off, lived with the mother. So it needn't be a dependent child. Descendant is the word. Child or descendant, not dependent. Or this unmarried person may maintain a home which he shares with any person for whom he's entitled to a dependency exemption. Suppose instead of your child, it's your brother who lives with you, and you support your brother and you get a dependency exemption because he's a close relative, you support him and his gross income is less than $600, you're a head of a household. Or you may provide a home which you don't have to share for a parent for whom you're entitled to a dependency exemption. So if it's your child or descendant, you needn't be supporting that person. If it's your parent, you needn't be living with the person. If it's your anybody else, you must be supporting and living with and get the exemption. Incidentally, on these joint return rates, there's also a special provision in the law whereby a surviving spouse during the 2 years following the spouse's death may continue to use joint return rates as long as there is a dependent child living. Okay, let's take 5 minutes now just to flip the tape, and then we'll start quickly. We need all the time, so just 5 minutes.